Hello, and welcome to the Performance Leadership Learning Lab's virtual roundtable titled Unlocking the Collective Value, How Syndicates Reshape Small Business Valuations. We're really glad you're here. A couple housekeeping items as we get started. Before a replay of today's webinar will be available via your email in the next several days. You'll receive a link to our YouTube channel, and that also includes all our past virtual roundtables, so enjoy those. If you have any questions for our panelists today, feel free to drop your questions into the chat. We'll be happy to address any of those either during the conversation or at the end of our recording session. So let's begin with introductions. I'm Will Gladhart, the Chief Marketing Officer at the Culture Think Tank and the PL3. I'll be your moderator today. I would like to thank each of our panelists for joining and also ask each of them to share a brief overview of their role and background. Will Lindstrom, we'll start with you, and then go to Abid, Bob, and wrap up with Angela.
Hello, everybody. As I mentioned, my name is Will Lindstrom. I am the CEO and co-founder of the Culture Think Tank and also one of the founders and directors of the Performance Leadership Learning Lab. I primarily spend my time focused on performance analytics and developing SageForge, which is a platform that allows us to prepare companies for better pre-due diligence and due diligence.
Great. I'm Abid Jan Mohammed. I'm an operator first, turned M&A, spent the last 25 years in the advertising, marketing, technology, and data spaces. And I tend to get brought in at sort of pivotal moments in companies to help them plan and scale to exit, and then run them through the M&A process.
Hi, everyone. Bob Dunn, Managing Director of GF Data. GF Data is a financial information product focused on the middle market. We have a cadre of more than 300 middle market private equity firms that provide their deal data to us for completed transactions on a quarterly basis. And we utilize that to provide benchmarks based upon size of company in terms of enterprise value or EBITDA range, to look at things like valuation, the leverage and capital stack involved in the business, seller rollover equity, but really singly focused upon valuation of middle market businesses that are private equity backed. Great to be here.
Thank you.
Hi, everyone. I'm Angela Rose. I'm founder of GSE Advisors. My background is in M&A advisory and business development with private equity backed platforms. Worked in acquisition, diligence, and integration with small business owners. As it relates to the syndicate, my role is twofold, and it's partnering directly with owners and focused on value creation and exit readiness, and also sourcing aligned opportunities for the syndicate as a whole.
Well, thank you all again for the introductions and for joining us. I'd like to begin with several thought-provoking questions for our panelists. We'll begin with Will Lindstrom. What analytics are most critical when determining whether a group or firm is ready for a syndicate formation?
Yeah, that's a good question. I think maybe we could start off with just kind of provide some context on what a syndicate is.
Perfect.
And so traditionally, there's just a couple of issues, and this gets back to what are the core metrics, but 80% of companies that want to sell in the lower middle market won't successfully sell. And of those that do, 75 have serious regret for a variety of different reasons. So if you put 80 and 70% and 75%, what that leads to is about 5% of companies that sell are actually successful from being able to sell and from the owner or the owner founder leaving. So that is one of the biggest issues. So that's just the metrics. What's driving that is largely a function of the fact that many companies in the lower middle market and in the microcap market are stuck in this no man's land. They're too big to sell to their founders or their other managing directors to do a buyout, and subsequently they're too small to be a part of a acquisition by an investor group. This is largely because investors are looking for a certain amount of EBITDA and a certain amount of revenue, which hits that point of optimism. In other words, I'm big enough to warrant the investment, and to do the due diligence. When you get too small, two things happens. The cost of doing due diligence goes up and the company specific risk increases because you have less diversification. So that's the issue. So what a syndicate is a syndicate is in essence a synthetic roll-up. What it does is it reverses the orientation. So rather than doing a traditional roll-up, I get one company, I buy another company, I buy another company. A syndicate is rather shifting the power, shifting the formation of a synthetic roll-up from the buy side to the sell side. So in this case, you can bring 5 or 10 of these companies that are small to mid-sized companies that are too small to sell. You can bring them together and allow them to sell collectively while still operating independently. So what this really does is it allows you to it allows the sell side, so these founders, to come together, form a syndicate or a synthetic roll-up, continue to operate separately until the time of sale, and then sell collectively, which will allow them to move their multiple, let's say, from 1 to 5. So it allows them significantly to improve their exit valuation. Now, to the question at hand of what makes a situation for a syndicate is typically what you'll find are you're going to find founders that are towards the 3 to 5 years, maybe even less than that, 2 to 3 years from wanting to sell. They've built up a tremendously good business. They're just too small. They have respect and they put a lot of energy into it. They've built up a legacy and they want to see it continue. Typically, they've tried to sell, but haven't found the right multiple. Or in the case of my father, he was a radiologist. He had an imaging center and same situation. So instead, we try to figure out how to bring other like imaging centers together. It didn't work for a variety of reasons that we have been overcoming through the syndicate model. And ultimately, we did a structured liquidation. And, it was a very sad day to watch my dad, close the door to 36 years. That's it, right? 36 years to close the door, no legacy. So ultimately, what we're really looking to do and what's a good fit for a syndicate model are those companies where you're 2 to 3 years away from wanting to sell, maybe a little bit shorter than that. You've got a business that's just stuck in no man's land. It's a good business. And if you could just find 5 other, maybe 4 other, maybe 10 other companies just like yours that can continue to operate separately and sell collectively, you can find a tremendous opportunity. And there's a tremendous amount of demand out there for these type of opportunities, which I'll let others touch on because they know the buy side better than I do. But ultimately, to answer that question, the syndicate is really those companies that find themselves stuck in the middle and just have historically not found a means or a mechanism to quickly scale to get to that right size for an exit.
Yeah, I saw several heads nodding between Bob, Angela, and Abid, so I'm sure you have some comments.
Yeah, I think from an overseas and European perspective, you see a lot of these. There are a lot of these sort of family-run businesses, just as William was talking about. And I think I've when I spoke to Angela last week, there's 3 or 4 that I can think of straight off the top of my head. But I think and they've all been told that they either need to expand, which then comes with all the costs that comes with, or they need to merge with somebody. And this idea of a synthetic roll-up, I think, for me, offers them a lifeline, but it also offers them, in a lot of cases, an exit, because ultimately, for the most part, it's a lifestyle business. And there isn't really, for them, a lot of these people don't even think about exiting because it's not the type of, if you're a practitioner, for example, a dentist, or you're an osteopath, how do you, where's the opportunity? There is also another scenario that I was talking to someone last night about around in the marketing services space. There are a number of different agencies and agency types. And if you start thinking about the concept of a synthetic roll-up, you could actually pull together multiple disciplines within the marketing services space. And I think that is something that is really, that no one's done it yet. We tried to do it a bit in the world of SPACs, but they never really kind of kicked off for one reason or another. But ultimately, and that's probably a whole nother podcast, to be honest. But the reality is, I think there are some really, really unique opportunities here because there are lots of buyers in market. lots of private equity money that's coming into things like marketing services, into healthcare, into these areas that need the sell side to start thinking, to almost create a package, if you like, that enable them to execute something that gives them the breadth of what they're looking for, rather than making 5 or 6 transactions, which are complicated, expensive legally, and fraught with all kinds of risk.
Yeah, I'll add a little bit to that as well. Having been on the buy side with a few different companies doing roll-ups on the buy side, one of the biggest frustrations is unsophisticated sellers. As Abid was saying, most of the sellers hadn't even thought about selling. So when we approached them, when I first spoke with them, it hadn't even crossed their mind how they were going to exit or when they were going to exit. They were just so focused on building the business and keeping that running and stable that they had never thought about what's next. So working with sellers, what really is exciting to me is working with sellers on the front end and helping them prepare on the front end and come together collectively and really putting that power back into the seller's hands, right? It's kind of this revolutionary idea where we're flipping the script on things and we're taking what, kind of those ideas and those playbooks that, private equity and some of the financial institutional models have used. And we're educating sellers and then pulling them together and empowering them to think about their business, but also leverage themselves together. So it's not about exiting together. It's about coming together collectively to leverage what they've built so far and then doing that really well. And as Abid mentioned, at the same time, we create a better product for the buyer, right? So that makes due diligence go better. The valuations are up. They can get their return on investment faster. It really delivers a better product to the market. So I'm really excited about it.
And Angela, I think that the psychological aspect that you touched upon there is, from the owner's perspective, is a huge element in this, right? You're going through the process in the traditional sense by yourself. You have expectations of the value of the business due to the size of these businesses. That expectation, as Will mentioned to begin with, statistically just often isn't realized. And I think that not only building and scaling up to a point where you're creating new opportunities for potentially private equity to invest into essentially a new business that wasn't at scale on it, but also, as you said, putting together people that are in the same space on it and allowing them to go through the process together to have not only be bigger in scale from a financial standpoint of the company, but also from a peer-to-peer standpoint on it. I think that's a very powerful combination as well. And something that, quite frankly, again, it's exciting because I really haven't seen it. At least I'm sure it's been done, but not on a large scale. So it's very interesting stuff.
Yeah, I think that's some great feedback. Bob, we're actually going to bounce back to you because, what financial and operational metrics, really most influence the shift from a 1x to a 5x EBITDA multiple?
Well, so, we're talking about scale, right? And I'd say if you're going to really look at it, to move up into that valuation, you're looking at getting EBITDA up to at least the 2 million mark, ideally to the 3 million mark. So you're talking about, if the average group going to syndicate, probably, 500,000 in earnings before interest, taxes, depreciation, amortization. That's EBITDA, in case anyone out there is not aware of it. That's kind of the gold standard on it. And that also, if you get to the 3 million mark, you start to look at like a potential platform acquisition, which gives you another potential turn and a half in terms of valuation on it. But you can't discount the underlying financials. Getting together a number of companies that are struggling, that are smaller, that are struggling financially, this is not going to be the fix for it, right? We have a metric in GF data looking at trailing 12-month revenue growth and trailing 12-month EBITDA margin. And if you do 10% and 10% in both categories, and we judge it as both, not an either or on it, we put you into an above average financial performance category. Now, that's not to say that that is an extraordinary performance, but think of that as kind of, the level you want to be at to start to command beyond scale an additional premium valuation on it. But in terms of, really moving it there, it is a matter of scale, but then operationally, how prepared are you on this? And I think this goes back to the safety, security, and greater understanding in numbers on it, right? So within a syndicate, you're going to have members that are better at their marketing capabilities. Some of them will have better back office structures. Some of them will have, leadership in certain areas that complements the syndicate on it. Being able to get that exposure, and I think have that within a package, is another thing that private equity is very interested right now. The private equity is on traditionally a 3 to 5 year time horizon from the time they buy the business to the time they exit the business. That means that first 90 days, that first 30 days is crucial on it. So again, having structures, systems in place that really work, having the right people involved, which obviously the PL3 deals with as well on it, that can really help to bring up that valuation as well on it. And again, going back to the beginning on it, it's not just getting the ideal valuation, it's getting to a point where you get noticed by private equity. And there are too many companies below that 2 million EBITDA level out there for private equity to look at all of them. So it's kind of a no man's land, but you get it up above there, it starts to become very interesting. And to go back to Abid's point, and Angela echoed it also, it's very compelling from private equity side too, because you are essentially creating new deal opportunities that isn't just a referral that no one else got. It's actually essentially a brand new company. And it's a company that's been structured in a way that they will probably continue to do it in terms of adding businesses to it. The buy and build, the roll up is very, very common strategy now. So this kind of giving them a fully baked omelet, fully cooked omelet, if you want, going into it, from a personnel side, from a financial performance side, and from a scale side.
Yeah, I'll just add to that. I was going to add to that a little bit. Bob hits a really exciting point, but also it's not really known by most sellers. It's that shift in looking at the business through the lens of the exit. So it's not uncommon that business owners would hire a coach or a consultant or advisor or someone to help them with their business. The difference in the syndicate model and what Bob was talking about is looking at the business through the lens of what are those pieces that actually add enterprise value, that increase the EBITDA, that increase the revenue, that increase the multiple collectively, so that the exit is stronger. And sometimes they don't know what they don't know. So that's the beauty of what Bob and GF Data can provide, is where are those breakpoints? What is that data that we need to be aware of? We might be close, right? I mean, they might be close to another turn and a half, but we just didn't know. But that's the beauty of what that data, the GF Data, provides.
And to touch on that, one thing that I think is also interesting to note about this industry, particularly on the PE side, is the buyers are not shy about what they're looking for. Like, they're very transparent, and that's very powerful, because they'll be very clear. Back to Abid's point on marketing agencies, they'll say, I'm looking for marketing agencies, I'm looking for this type of services, I'm looking for virtual or not virtual. They'll be very clear on that, which is very powerful information. So by gathering that information and understanding what their thesis, what their buy expectations are, you can assemble the syndicate in such a manner that it's optimized or optimal for what they're looking for, which is only going to give you more value and higher returns. So that's something that also the syndicate allows you to do, is it provides that flexibility to assemble those like organizations specifically for a buyer's market, or not a buyer's market, but for a buyer's thesis, that then creates that competition or that need or that buyer's frenzy, which is just going to give, one, it'll give a better product to the buyers, but two, it'll get more value back to the founders.
It also, just to add to your point there, the other thing it also does is it gives you speed to market, right? Yep. So if I'm a PE, and actually from a cross-border perspective, it's really interesting, because there's a lot of US PE money looking to come into Europe. The scale in Europe, in the UK as an example, it's not the same. So when a US PE group, which I've done buy side work for, they're looking for a business that's doing $1 million to $2 million EBITDA, right, in the marketing services space as an example, and like those businesses are few and far between, right? There aren't that many independent founder-led agencies that are in that 1.5 to 2 million EBITDA, right? But it's but the PE, to Will's point, they're like very explicit. We want this, and sometimes they sit there and they go, this is quite hard, and it's quite hard to justify to their ICs to take a business that's at, I don't know, 700,000-800,000 EBITDA to try and put that into their model. It just doesn't work. So the speed to market that we can offer, that a syndicate can offer to a private equity group, I think is really interesting. The other area that I look at, there's a lot of I guess listed companies, Nasdaq listed companies, big buyers who really struggle to buy what I would call like a science project, where for especially in the world of AI now, right, where you've got really smart founders, technical founders, but not really who haven't necessarily built or run a business or run a sales team. But they've built something, they've got a little bit of traction, they're doing like sort of 500-600K in revenue, but they're very difficult to acquire because the metrics just don't work, right? But what this essentially allows a bigger buyer to do is almost go, actually, we can make an acquisition of a business that kind of fits 60% of what we want, right? And then we can bolt in these 3 or 4 science projects, super technical businesses, and effectively go, right, actually, we've now got a company that has 90% of the capability that we wanted, right? And we can make that, but we can use this shell or this front end thing to be able to make those 5 acquisitions in one go, right? And actually that, I think, while this works for those founders also that as we've spoken about before, that weren't thinking about an exit or didn't even think it was available or on the horizon, I think this syndicate model can also work for bigger buyers that are looking to try and bring in like innovation and that kind of capability, but don't know how to do it because it just doesn't fit the playbook of a Nasdaq listed company or a FTSE listed company.
Yeah. I think that's some really great insight, Abid. Will Lindstrom, will bounce back to you because we've talked about a lot of the thoughts about the independence, how these things are created. So I think it's important that we touch on, how will PL3 or the PL3 Community Forum, support both advisors and these independent owners as they start to build, create or address the gaps and then also prepare, for collective diligence.
I think that's a good question. I think another way to frame it is almost the reverse: is why historically haven't syndicates come together, and why has it always been historically a roll up where you buy one, fully integrate, buy another one, fully integrate? And I can just touch back on the experience with my father. He had a good running business. It was solid. It was growing. It had all the things that everybody would want if it was big enough. And when we approached the 6 other clinicians or practice managers that were all in the same space, all at the same age, all looking, 2 things became apparent. One is, in order to have an effective and efficient syndicate, you have to be all on the same financial platform. So in other words, you have to be reporting the same financials and the same chart of accounts in the same manner in best in class that aligns to how the private equity or the investors are looking. Typically that is very hard to do. In the case of my father's situation, 3 of the companies were on 3 different practice management systems because they all had 3 different sources of the equipment. And so that was a huge hurdle. Fortunately, with AI as a beat touch, that problem now goes away. And that's what we've been working with SageForge. But basically, you can just ingest everybody's charts of accounts, use AI to normalize them to best-in-class standards, use AI to do the adjusting entries so that you have the tax base and the value base, because obviously, while you're running a business, you're mitigating operating expenses or maximizing operating expenses in a declaration because you want to minimize taxes. You want to flip that when you're looking to sell. So that's the first thing I just refer to as the messy books problem. So AI takes care of that. The second thing that it takes care of is oftentimes I call it the rooster problem. You get 6 extremely smart people in the room together. They're all going to try to figure out who's in charge. And then they're going to figure out what the leadership team works like. So that's why it's really important to make sure that you get this concept of you still are going to operate separately. You're still your own LLC. You're still running your own operations. You're still running your own technology. The only thing that's above you, the umbrella, is really the AI. It's bringing the finances together and the other KPIs, marketing, sales, all those other KPIs. but allows them to operate separately. This keeps the rooster problem, but it also provides the flexibility, because as you build up these syndicates, if you have 12 and one gets cold feet, well, they can step out and not ruin the syndicate model. So you're not dependent on that. That's the other issue. And in the cases of a syndicate that Angela and I are helping form, one of the other concerns is I don't want anybody to know that I'm selling my company. So there's this big confidentiality, fear of letting anybody know. So in the case of that formation, basically when you apply to join the syndicate, you don't know who else is in the syndicate. And the beauty is the private equity firms, the buyers don't care, because they're all geo-locked mostly in this case. They have a good geo. They're doing a land and expand model. There's some operational efficiencies, but largely they're buying in for their footprint. And so you don't have to know until that point where you're like, okay, yeah, the syndicate is formed and now we're ready to go, and you sign that LOI. So you're overcoming those three big issues, which is the messy books, trying to figure out who's in charge and recreate a leadership team and do all the LLC. You don't have to worry about any of that. And also the confidentiality or the privacy issue. People just don't want to sell. And, there's this concern. Well, best way to sell is don't tell anybody. If nobody knows that you're selling, you're part of it. So those are the three things that, the last two you could overcome historically. The biggest one is the messy books problem that AI now makes available, because, I used to do data analytics for very large companies, and we, put together, trying to do comparative analytics against 5 or 6 plants would be weeks worth of work. Now that all can be handled in hours. So that's the beauty of where we're at. But then you have the other aspects. But this environment we're in now, so it's almost like an infrastructure. This infrastructure is available now that you can actually assemble. You have the bones to assemble these 12 like organizations, let them operate separately, position them to sell collectively. And the other advantage is that when the sale happens, they all sell individually on a legal basis, which means that any type of earnout or any type of, I want to stay on 2 more years, I want to stay on 1 year, each one is actually determined at the syndicate, at the individual member level of the syndicate, which provides that flexibility. And so long as that is known up front, the buyers are okay with it, and you have the operational due diligence already done. So it works out really well in that capacity. So that was a lot in a little, but those are the 3 big issues that have historically gotten in the way that now are no longer these hurdles. And back to Bob's point, and Angela's, now you're kind of more in the psychology of it all, of like, wow, this is a possibility. What if I'm 500,000 in EBITDA, I'm getting 1x and I can go to 5x, it's 2.5 million. Is that really, it's getting people comfortable with that. That's very, very possible.
Yeah, I'd like to add to that what Will said as it relates to the PL3 community. I think, like, personally, what's really exciting to me, and also, as Will mentioned before, why hasn't this been done before? I think it's just assembling the team, right? It's this idea of, I think the idea of coming together as a community and selling collectively, I do think it's a rather new idea. And I also think that a lot of people think about, gosh, where would I even start, right? Who would I contact? Do I do that? Like, who helps me with that? Is that my business coach or advisor? Is that my CPA? Who does that? And what this PL3 community has done is it has brought together various advisors who have different roles within the syndicate business model, right? So what Bob does and what I do and what Will does and what Abhi does, like all of us, we all have different roles in the syndicate, and we work well together. It's almost like, we are that, financial institution or private equity team, but we're independent, right? And we're on the side of the seller. So I think the power in that is that we speak a common language. We are all team seller. We speak a common language. We have desired outcomes, which is, how do we help these sellers create a legacy impact? Whereas before that it wasn't even in the cards. The idea was, someday I'll sell and hopefully someone buys it, or like Will's dad, he ends up closing the doors, or I'll hire a broker who's going to take a 15% commission on it and list it on their website. So I think, our community is just team seller. We're excited. We've got common language. We've got common standards. We've got, desired outcomes, and we all sit in different roles that work really well together. And I think there's a tremendous amount of power in that.
Yeah, I think that's a fantastic point, Angela. Abid, we'll pop over to you. You kind of touched on what does make the syndicate opportunities attractive to overseas strategic buyers or investors. But maybe thinking about, from your perspective, how the syndicate model might really expand more in the domestic US, but also the global market, even more so in the next 3 to 5 years, just as maybe a prediction or projection.
Oops, sorry. So yeah, I think this model has got is gonna. I think there are more and more buyers as more and more private equity money comes into the space. I think this model is going to scale. Partly because it enables them to diversify their risk, right? And it's almost like a ready-made risk diversification model. And as I said, it kind of speeds up their route to market, or their market entry, because there's a lot of like, for example, a lot of US businesses know that for them to scale, to grow and to get to that next stage, they need international, right? A lot of European businesses go, hey, the scale's in the US, right? We need to get the US. We need to, even if it's like where, and it's almost that question of like, where do we go? How do we do it? So I think that there's a lot of the cross-border nature of this is going to be has huge legs. I think that as a structure, and to sort of, Angela's very passionately talked about the model and about the community. I think as we, because of the sort of standardization of stuff, because of AI coming into the market, I think there's a huge opportunity for some of the bigger buyers as well, and more sophisticated buyers to start to look at this. I mean, I'm working on a deal right now where actually, the buyer is PE backed, and this is a tuck in for them. But actually, what they'd like to do is make 3 or 4 of these types of acquisitions all at the same time, because then that gets them from being where they are today to actually somewhere out here much quicker. Especially where there's a sort of race, right? And in a lot of, you think about all the industries, and I've spent a lot of time thinking about this. Industries where you've got whether it's medical, health, and wellness, and all of that, which is an really interesting space, because those guys are that group are in a position where they have to think about the next stage. I'm originally from Africa, and I was on a call this morning with a family office that have built a business that's a $40 million business, but they are at the sort of 2.5, 3 million EBITDA, and they're going, well, how do we exit? How do we scale? Right? Because this number is not kind of enough, and they've had 4 conversations or 4 approaches from partners, or competitors in the same space or in the region on the continent, going, yeah, if we merge, what does that happen? What happens there? So to Bob's point, to go from 2 million EBITDA to 10 million EBITDA through the syndicate model, I think that there's the opportunity globally for this as a concept is huge, and it's less kind of faddy than a SPAC, right? A SPAC was this thing that everyone got really excited about, but there was no real, the underlying metrics and the valuations in some of the SPACs were just ridiculous. Whereas actually here you've got, you're not moving away from the M&A fundamentals, right? You're still using the same data, you're doing all of that stuff, but you're diversifying the risk and the fundamentals. So to buyers and to PE, you're not kind of sort of out over there going, I'm in cloud cuckoo land because I've decided that this is the way the world's got to operate. I'm actually going, well, how do you want to buy? You want to buy like this? Okay, well, here's a model that basically fits. So that's the way that I look at it, and I do think there's big cross-border opportunities.
Excellent. Any other thoughts from our panelists on that? Otherwise, I've got a question for Angela. So we talked about a lot of things about the framework of the syndicate, kind of how it works, how the community supports it. Maybe a great question is, what early signals indicate a company or owner is a strong candidate or recruit, even to begin the conversation?
I mean, I think every business owner should be having the conversation, if I'm honest. Well, let me rephrase that. Um, Once you've certainly not new business owners, right? I mean, someone that's just starting a business, someone that's probably 10 years in, getting their legs and getting all those systems down and getting the rhythm, definitely not. I personally don't think. I mean, everyone says start with the exit in mind. I don't necessarily agree with that in this situation. I mean, we really, I think for a small business owner, you have to at some point think about what does next look like for me, right? And is it a next level? Is it I'm going to buy another business? Is it I'm going to pass that down? What does next look like? And I think that's just smart business planning, right? And it's also because these businesses are founder led, they should be thinking about it because if something does happen to them, then the business could crumble overnight. So I think they, I think it's just great business planning and awareness to think about it, to start thinking about it. And then, of course, as Will said when we started the call, if you're within 5 years or so, you really need to be thinking about it because there are things that have to be done all across the board for businesses. It really goes, there's a difference between a business being attractive and a business being ready, right? So just because a business is approached for a potential purchase or acquisition or interest doesn't mean it's ready. It's great to, as a business owner, to get that interest and get that attention, but if the seller is really going to maximize the value, they really need to shift their focus from the day-to-day operations to that lens of how do I de-risk the business? How do I know my value? How do I grow my value and do that? What's my greatest path to do that? So that's maybe a little more than
No,
that's what I think.
that's great. Any
And I
thoughts?
think that self-assessment on it, right? And that's really what it is. And shifting thinking it, right? Because you can have a great business, you can be growing annually and everything, but those aren't strategic goals. That's just the
Right.
business is performing well. But, you know, the business will not continue to perform well without some sort of a goalpost that you're going for on it. And your employees won't be engaged without that, So it doesn't necessarily mean to be an exit, but I do think when you start talking about an exit, you start talking about shifting the perspective, as you said, Angela, but in this case, from the owner's perspective, where it's their baby, it's been great, supported them, everything else on it, to a potential buyer's perspective, right? Like actually going in and seeing where there are holes within the operational structure, um, seeing inconsistencies within, where revenue is generated, like actually going in and doing a thorough analysis of the business, whether you want to exit or not on it, but doing it from a buyer's perspective is going to yield a lot of opportunity on it, whether you actually go through with the sale at any point in the future. But I think it also keeps the business from stagnating, getting stale on it. Because again, just continuing to grow, that's great. But you need a reason for that growth and you need something that growth to lead to on it if it's ultimately going to be a sustainable business or a business that successfully sells into the marketplace.
I think that's just good governance, isn't it, Bob?
Exactly. Yeah, but which is often lacking in,
Yeah.
Well,
in
100%.
that
I think
disguise scale.
yeah.
Yeah. Sorry, Avid.
I think it's a really good point. Like I've done and over the years worked with various companies that you do effectively an options review, right?
Yep.
I've had some inbound. I want to sell. What does my business look like? The amount of companies that don't necessarily look through the lens of a buyer, as Angela says,
Yep.
and they think that they have this slightly crazy view on valuation in some instances. In other instances, it's something that actually helps them then take that next step and work out which route to go down. So
Yep.
I think the governance piece is something that is often missing, but definitely
Yep.
something that's worth thinking about.
Yeah.
It's that idea that no one wants to hear their baby's ugly, right?
Yeah.
It's like, listen, I mean, and we all have that view that we have the most beautiful baby. And, I think the idea is it's not a question if they're going to exit. The exit is inevitable. It's just how that
Yeah.
exit is going to happen and when. So there's lots of exit options. Closing the doors is an exit option. But like Will's dad and so forth, it's heartbreaking to see. So I think it's also just shifting that mindset of saying it's not an if, it's a when and how successfully and what timing and how does that align with my personal life and my personal financial goals, right? It's more than just the business also.
Yeah. Perfect. Well, before we wrap up, we have one question for the audience today. So the question is, if you're a solo owner but want to create a syndicate, where do you even start? How do you find other businesses in your world that are looking to sell? Is that where SageForge or the PL3 comes in and they help coordinate that or help build that model?
Yeah, to answer that question, we've been working on that because what was interesting is we looked at when we initially formed the PL3, we were looking at just how do we fix this inefficiency in the marketplace. And then what came about, kind of to Angela's point, is well, there needs to be some coordination. And so what we are working on and rolling out is for owners that are interested in forming a syndicate and growing. We have a very it's just going to be a very simple application process where you can apply. We're going to look at kind of what your core goals are, and again, we're going to do that and we'll help centralize that. But we're doing that in context to what the buyer's looking for, because we want to be able to match, and then we can provide a very clear roadmap of, okay, this is what you look like. Here are the buyers that are out there, or maybe there aren't, but most likely there are. And then here's what the scale would need to be on the EBITDA to get to it. And here's some expectations. And that's what we facilitate. And then once that's established, the interesting thing is there are plenty of companies, plenty of fiduciaries, wealth managers that are all trying to help like companies get that higher rate of return. So part of Bob's network with GF Data and ACG and everybody else's with EP Exit Planning Institute, we can reach out and then recruit those other syndicate members in around that thesis. So that's what's really exciting. It's more back to Angela's point. We form a team, we help pull it together, and then we'll manage that process. But we do it all, back to Abid's point, aligned to the core M&A process. So as we go through this, we're just right from pre-due diligence to due diligence. We're lining this up to be right aligned with M&A and the private equity expectations. So you get that high turn, and you have the smoothest. Due diligence is never fun, but you can at least make it less unfun as you go through it.
Excellent. Well, thanks so much for joining us today for our guests and panelists. We hope this conversation sheds a little more light on unlocking the collective value, how syndicates reshape small business valuations to create stronger outcomes. This roundtable is part of our monthly series from PL3, where we explore topics like leadership, organizational performance, AI, cultural alignment, and investor decision-making in greater depth. Next month's topic will be a session focused on leadership performance theory, and we hope you'll join us. To learn more about us, you can visit us at pllab.com. We'll see you this next month.